Hey, welcome back to Two Stupid Guys Trade Stocks. I'm Dylan.
And I'm Vinny, and today we're going to talk about this new indicator and some other economic data that came out this week. Well, new indicator for me, I should say, that kind of points at something not so great. Obviously, a lot of people have been saying this for a while, including us, but it's just an interesting data point to add to your own repertoire of understanding what the hell's going on in this economy. But with that, we'll get to it.
Two Stupid Guys Trade Stocks.
So, we're going to get to it here in a second, but basically, we had a GDP number that came out that was even better, right? GDP is gross domestic product, or the total amount of things produced in the economy. You're hiding right now over GDI, which is another data point here, is gross domestic income. Theoretically, everything that's sold in the economy is someone else's income, right? So, like, their
Right.
flip sides of the coin is the thought process, and that over time they should converge. And we're at a point right now where we're at like the widest spread in I think 30 years was one of the data points.
Really?
Yeah. As you can see, this GDI number has been largely negative as GDP continues to climb like higher and higher, and even be revised higher this week.
So, how does that make sense? How can it be that far different?
Yeah. I mean, that's a good question, right?
That's weird.
I don't have an answer, but it's worth asking. So GDP was revised this week up to 5.2% an annual rate. That's a big, sexy number for an economy as large as the U.S. economy is. Right? We aspire for a 3% growth rate. So when you're aspiring for 3% and you get 5%, that's a pretty significant margin of, I would say, better than expected results in many ways. Now, whether or not that has legs is an entirely different discussion, but the original estimate was 4.9%, was revised up to 5%. Um, the one of the larger drivers of this was government spending. 5.5% annual pace. That's obviously sustainable over the long term.
Yes. This doesn't
Yeah,
make any
I know.
sense. This is
Yeah,
crazy.
no, right. One of them was actually like it was a category that didn't really make a lot of sense as far as like the intellectual property investment and things like that. Well, I guess it does make sense, but I'm just saying it's one that is was negative number last term and last quarter, then was now like 1.5%. So pretty dramatic swing. So it's kind of like if that were a CPI metric, it'd be eliminated from the core one, right? Because it's a pretty volatile category.
Right.
So get some more movement there. One thing that was revised down was consumer spending. 3.6% as opposed to 4% growth. I kind of want to do a separate video at some point about like consumer health overall because like CNBC just dropped one today about credit card debt and it's pretty wild.
I feel like we've done like credit
Yeah.
card debt video like a couple times, and each time it's like this is the worst it's ever been, and then like 2 months later it's like worse now. And it
Yes.
just keeps. I think we're at like over a trillion. Like,
Yep. Over a trillion. Yep.
okay,
We are indeed.
dope.
So this other article came out this week kind of responding to the GDP upward revision and saying that GDI may be a better metric and why so and like what that represents. So we're going to kind of go through that article here a little bit. So GDI, gross domestic income, annual rate of just 1.5%. Okay. Um, over the past, has grown feebly over the past year, even while GDP has been advancing solidly. Well, the past 4 quarters, GDP up 3%, GDI is actually negative 0.16%. All right.
And
So very much headed the opposite direction. And that's the biggest disparity between these two measurements in recent memory. There's another point here. I can't remember if it's in this slide or the next one, but they talk about it was actually like 30 years ago. Oh, yeah. Largest gap since 1993 between GDP and GDI.
that doesn't make me feel so. If I'm looking at the market, I'm thinking, man, this does not make any logical sense. We have to go down at some point. But the 90s were pretty solid for the stock. I mean, it didn't end well, but
Yeah.
they had a
I
pretty
mean,
solid growth.
and 1993, don't forget, is the year that Jurassic Park came out, okay? It is by
Big
far
deal.
the peak of cinematic achievement.
Big deal.
Okay?
Absolutely.
Yeah,
I
my
don't
personal
understand how a
opinion.
T Rex can sneak up on people, but yeah.
Yeah, you're absolutely wrong. um, but the whole premise here being that this is just like GDP is overstating the strength of the economy. There's 8,000 naysayers out there every day, and the real thing you should do, right, in based upon evidence, is continuing to dollar cost average into low cost index funds. That's the right answer. But for those of us that actually like to try to understand this, do it. Does it really change my behavior? Not significantly, but I really too want to like try to understand where the money flows and what makes the kind of gears turn here. Um, So, this is adding to the question of whether or not we will truly see like a soft landing next year. There's another data point that I didn't put a slide in here, but looking at, kind of smart money and how it's buying bonds like no tomorrow all of a sudden. You've seen how far the 10-year yield has moved in your TLT trade in the last like 2 weeks, right?
I'm
Pretty
so
dramatic
glad
shift.
I did not do a covered call on that. Man, I would have gotten called. Also, TLTW got called real bad.
Yeah.
They lost a bunch of money.
I'm not surprised. So these two gauges should arrive at exactly the same total, right? That's the premise here, is that these things actually should give you the same number. They should be a converging indicator over time, and they should always actually report the same exact number. But when they start to get really separate like this, it's something you should pay attention to. Tend to converge. Yep. Um, See, and there was a Federal Reserve a research paper where they talked about GDI actually being a better metric than GDP, um, more accurate, as rather than simply poll businesses, it relies on hard data such as unemployment insurance claims to measure wages and salaries. So it's not how do you feel; it's truly what numbers are like, your vital signs
I
or
would agree with
objective
that.
data.
I mean, I'm gonna. I don't want to sound ignorant here, but I have never looked at GDI. I've never ever gave that any thought, but I would agree with that. I'd appreciate hard numbers over opinion.
Yeah, it's a new one for me personally too. I haven't heard people talk about it before. Um, so, particularly they're saying GDI is very useful when you're at a real transition point between phases, which obviously people have been saying this for a while, but we arguably could be. We'll certainly appear to be in a Fed rate plateau as of right now, where we could be headed towards an inflection point and transition between cycles. So maybe it is a more useful metric at this point. On the flip side of the coin, if you want to argue that in reality everything's hunky dory, is that inflation in the eurozone came in well below expectations, down to like a 2.4%. This is not something that's being predicted for the U.S. economy until like 2025 to be down in the twos. So they had a significantly higher peak than we did at over 10%, largely driven by the war in Ukraine and the effect that had on energy prices for them.
Yeah,
But they've swung back the other way dramatically. So
they had a huge energy crisis that kind of inflated that number more than it
yeah.
should have been.
Yep, and it's funny too. Their core excludes not only energy and food, but also alcohol and tobacco.
Nice.
Which is interesting. Yeah, it's not,
Fort.
to my knowledge, that's not excluded from our core. It's the American way.
It is. America's built off of that.
Yeah. And so their peak was 11. I'm sorry. The energy is now at a negative 11.5%. That's how much the energy has now become like a tailwind in terms of prices down. You'll see it on the chart here a little bit better. But yeah, look at the energy spike, just
Yeah,
massive
I mean,
run up in energy, and now it's actually come down and become like a negative tailwind, helping drive down inflation overall for the eurozone. So no, kind of interesting. Just this GDI thing was what caught me by surprise, and whether or not we'll truly see a reversion where these two things will converge towards the mean again, or if we're going to continue to be at the extreme since 1993 of divergence between these two indicators, which is not something when you hear first time in 30 years. How many times have we heard that over the last like year and a half, 2 years?
a lot, like all the time. Like it's
Yeah,
just like every month, it's like something. This statistic, whatever it is, hasn't been this bad since the '80s. It's just it
yeah.
happens. There's a new one. There's another one. I don't know. Doesn't make any
We're
sense.
living in quite a phase of the market cycle, that's for sure.
I don't know. I have no words. I will say the Qs are looking real peaky. And it would be interesting to kind of see what happens here. But all right, guys, let us know what you think. If you think a GDP or GDI is a better indicator, and what's happening, because that doesn't make any sense. I don't know.
Yeah. Catch you next one.